Hello there and welcome to the Business Interview. I'm Marcus Carlson. Today, we're looking at the risks of doing business in Africa. African economies are displaying strong growth rates. It's providing plenty of opportunities, but let's also take a look at the potential pitfalls. My guest is Stanislass, Zézé, the Chief Executive of Bloomfield Investment. It's a credit ratings agency based in Ivory Coast. Welcome to the show, Stanislass.
Thank you.
Now, first of all, when you hear credit ratings agency, or at least when I hear that word, I think of Standard & Poor's, I think of Moody's, and I think of Fitch. You're different from them. Tell us a little bit about your business.
Actually, we are a regional credit rating agency based in Côte d'Ivoire and Ivory Coast. You have to know that there's 70 other regional credit rating agencies throughout the world, actually. And the reason why we have this rating agency is because the international rating agency, Fitch, Moody's, and Standard & Poor's, have a difficult time sometimes in certain very specific market to actually have the capacity to master the risk.
So basically, they may be good at providing a global picture, but perhaps not a regional picture.
Well, a global picture when it comes to rating on the basis of foreign currency of reference, let's say the dollars. But when it comes to local market, they have more difficulties because, you have to be close to this market. You have to be on the ground to be able to better master the risk embedded in the investment in these regions.
Names like Moody's and Standard & Poor's, of course, they've caught a lot of flack after the financial crisis. How are you doing things differently from them?
Actually, we are in a very regulated environment. As a matter of fact, in West Africa, there's regulation. The market authority have actually put in place a very, very, very strict regulation to actually make sure that what have happened with the subprime does not happen in this area. We are controlled by external entity that actually see the adequacy between our methodology and the reports that we pull out. So the regulation is so strict that that would definitely prevent what have happened in the U.S.
Mm-hmm. Now, there's a lot of focus on Africa and African growth rates in particular at the moment. But so far, these economies, they've been seen as a little bit of a Wild West. Does your existence mean that Africa and African economies and African markets are maturing?
Most definitely. No, not only they're maturing, but they're starting to understand the importance of being transparent and the importance of good governance, actually. Although Africa becomes very attractive in terms of investment based on the return, the high return that investment can actually expect from the investment in Africa, there's also the notion of risk. People want to make sure that even if the investment, the return is high, they want to make sure that they invest where they can actually mitigate the risk. So this is something that has been clearly stated to most borrowers in Africa. Mm-hmm. And Bloomfield have done a lot of work on education with regard to credit rating. So they do understand that. So now we have a lot of people actually who come in willingly to the credit rating agency to establish the credit quality. So the market is definitely maturing.
Mm-hmm. So you think that risk levels, they have come down in, let's say, the past 10 years or so?
Well, let's say not necessarily that they have come down, but what I mean, we have actually a better understanding of the risk. Because what investors want, actually, they don't want to invest in a risk-free zone. They want to know the type of risk they're taking. This is very important. This is what they really want these days. This is the reason why, when it comes to very specific market and emerging market, they want someone who actually can tell them what type of risk they're taking and what type of return they can actually expect from the investment. This is why they usually start working with local and regional credit rating agency rather than working with international credit rating agency on these specific markets.
What are the main risks of doing business in Africa? Of course, the continent, it has 55 different countries, so it's difficult to paint a wider picture, I suppose. But in your view, what are the main risks?
The main risk is actually regulation. We are in the market that are too regulated, and that can actually be breaks to investors, and also the judicial environment.
The rule of law, basically.
The rule of law, basically. But there's a lot of progress that have been made in this area, but this still remain the highest risk in the sense that investors want to make sure that if they are in confrontation with a borrower, they want to be able to have a fair trial, which is in most countries not really the case at the time being.
And do you think that the rule of law is that improving, or are we stagnant?
It is definitely improving as the politicians in Africa are starting to understand the importance of creating a conducive business environment so that it can attract foreign capital, private capital in a sense, giving that for the public capital they don't necessarily need to have a conducive environment for that. But they realize the importance of private capital because this private capital are not actually attached with conditions that would prevent them to actually lay out the strategy in terms of a development plan. So they tend to be more and more interested in private capital. They understand that private capital will only come if the environment is actually conducive to business.
Mm-hmm. I want to talk a little bit about the investors that look at your ratings. Where do they come from? Are they African investors or are they outside investors?
Oh, yeah, you have all type of investors. They mostly come from the region, from the continent, Africa, but you have a lot of them coming from Europe. And also we have the Americans actually starting to have a good appetite for Africa. And since they realize that there now there's credit rating agencies on the continent, because there's 3 of them actually who are actually doing ratings, they're starting to come. So we've been contacted by investors directly or representative of investors to discuss the rating of sectors, because we do sector analysis, we do country risk analysis, we do corporate analysis and financial institution. We do all 5 risk categories. So we've been contacted by investors everywhere, and more international investors are being very much interested in our ratings.
There's much hype about how China is marching into Africa and that it is basically taking over large parts of African business. Are you seeing proof of that?
Yeah, well, at first it was actually a way for African to diversify from the European and from the Western world. But they tended to realize that, of course, business is business, and the Chinese are not coming to invest because they're good Samaritan. No, they're coming because they're expecting a return on investment. But the good thing about this diversification is actually allow the African to have the choice, and also have the opportunity to discuss better conditions with the Western counterpart. But this wild investment from China is starting to stabilize. Now I think that now that we established that African can actually diversify the investors, now this fear of Chinese taking over is actually coming down.
Okay. I want to talk a little bit about, here towards the end, about mitigating risks when you're doing business in Africa. We spoke about the lack of rule of law before. How do you mitigate that kind of risk? For instance, how do you get around it and make sure that it doesn't impact your business?
Actually, it's the way you interpret the risk. You know that a different environment have different culture, and the culture has a very important impact in evaluating risk. Obviously, once you have all the parameters that actually represent the graphic of the graph of risk, then you actually put in place a different element to mitigate that. Mm-hmm. For the rule of law, for instance, obviously the contracts can be a contract that actually said that in case of conflict, we can actually establish the tribunal outside the country, for instance, in a neutral tribunal where we actually have the chance to have a fair trial, for instance. And there's other parameters that will be on a case-by-case basis, based on who you're doing business with, what is the connection of these people in the country, are they people politically related, are there people who are political connection, who can actually have an impact on the relation, the business relation that we're going to have. So it's difficult to establish one mainstream attitude to have when it comes to this type of risk.
But if you have one very practical advice, I suppose it could be, or the way I interpret what you're saying, that you should put your eggs in many baskets, so to speak.
This is true, but also what you have to understand also is very important is a lot of the borrowers or the company that borrow from the international market or from the stock market, a company who have assets a little bit everywhere. They're not concentrated asset in the same country, so they can have assets in France, Europe, in the United States, in Africa, and in Asia. So they can be actually be taken into court in this other part of the world where they have assets. So obviously that mitigates the risk for investors who come and invest in this particular company in this particular country. If they have decided to use a neutral arbitrage when it comes to conflict, then they can also obviously attack them in other courts outside where they have the assets and where the rule of law is actually stronger than where they have the initial investment.
Okay. Stanislass, unfortunately, we have run out of time. It's been a pleasure to speak to you. Thank you very much indeed for coming into France 24.
Thank you very much, Marcus.
And with that, we're also going to wrap up this program. Thank you for watching.